Welcome back to the Retirement Income Show. I'm your host, Wes Wood, and today we're talking about our retirement readiness quiz. Take a look at this. No airplane pilot would just jump into a plane and take off without doing his pre-flight checklist first. And that's very reassuring to all of us passengers sitting in the seats, right? But by the same token, no one should take off into retirement without making sure that they're absolutely ready for it, mentally, emotionally, and financially. And that brings us to the final question of our retirement readiness quiz. Have you made the strategic shift from portfolio growth to retirement income? Now, on some level, everyone knows they need to start generating income from their investments once they've retired, right? But the common misconception is that you should wait until you're already retired to make that shift. Some people believe that they should invest for growth right up until retirement day when they're handed that gold watch, which I know not many companies do anymore, but you get my drift. The reality is that shifting from growth to income is an important step getting ready for retirement. And it's best done during the transitional years. And transitional years are going to be those 10 or so years before retirement when the kids are grown, you've accumulated some savings, you're almost eligible to take Social Security. And for most people, there are plenty of good reasons to make that shift during this time. And the only reason many don't make this shift is because they do not fully understand the investing for income model. They've been led to believe that investing for income means actually sacrificing returns. They believe that they need to keep investing for growth right up to the bitter end in order to build up their retirement nest egg. Well, as my kids would say, and all the kids would say out there, that's just wrong on so many levels. For one thing, sometimes the stock market not only doesn't grow, but it shrinks. This means that investing for growth means investing for the big unknown. Okay, if you're 20 years away from retirement, that's fine. But if you're only 5 to 10 years before retirement, it can be extremely risky. And the more important thing to understand is that growth and return and growth are not synonymous. Return is the sum of two things, growth and income. Growth is measured by capital appreciation, and income comes in the form of interest and dividends. By investing directly for interest and dividends, you may get a bit less total return than you would continue to invest for capital gains, but you also reduce the risk of a major loss. That's because investing in bonds and bond-like instruments in an income strategy are designed to protect you from market volatility and to guarantee your income return regardless of market conditions. And even better, there are certain dividend strategies that you can use to keep growing your portfolio organically through strategic reinvestment. And those can be even more effective when the market falls. The bottom line is, that's a strategy that's not only serves you well in retirement, but it's a strategy that makes you get ready for it as well. Now, discover for yourself today by reaching out to me directly at retiretv.com or by calling 855-776-0614. And we can make sure you're on the right path to a successful retirement. Now, let's welcome back David Scranton one last time. Welcome back, Dave.
Thanks, Wes. But wait a minute, though. Are you trying to tell me that when your team members retire, you no longer buy them a gold watch? I mean, that's so wrong on so many levels, Wes. I'm sorry.
It sure is. Yeah. No gold watch for the team members when they retire. But you know what the funny thing is that when I talk to my clients that are retired, they said they don't need a watch anymore because they don't care what time it is. They can sleep as long as they want. They can do whatever they want to do. So why bother giving a gold watch away, right?
That's a great point. That's a great point. And you know, but what's also wrong on so many levels is when somebody comes into your office and says, well, Wes, I've got, let's say, $1 million. I need 4% of that per year for income. Let's call it $40,000 a year. But I know for the first 20 years of the century, the market's averaged over 6% return. So if the market's averaging 6% and I'm only taking out 4% a year for income, I should be okay 20 years later, correct?
Yes, I hear that often. But unfortunately, that's not the case when you're pulling money out of a portfolio. Even though the market may have averaged 6% return, it's not, as we all know, it's not 6% year over year over year. The market falls, goes up and down, and think about this. Going back 20 years or so, even a little further, if you invested $1 million and the market started dropping and you're taking $40,000 a year out of the portfolio, well, what's happening? You're now having to liquidate more shares from that portfolio in order to get to that $40,000 distribution. And it's something called reverse dollar cost averaging, which can actually be devastating and can cannibalize a portfolio over time. But if you invest for income, instead of liquidating principal when the market's down, investing for income, and you're just spending the interest and dividends, even if some of those shares are maybe down in value, we don't need to liquidate because we're just spending what the income is generating. You're exactly right. Sequence of returns has a big deal to do with it when you're taking money from a portfolio.
I remember you showed me a stress test you done one time for a client who retired in the year 2000. And because the market was underwater for 13 years from 2013, I remember that person had just about half of their money left 13 years later. Even though the market recovered, they didn't recover because it spent that entire time underwater. So
that's right.
You know, I know you tell people now as a result of that you don't have to be anti-growth. You can still get some growth, provided that you make income the priority and growth is the secondary goal, correct?
That's exactly right. Even those folks that are in those transition years, 10 years or so from retirement, that's a really good time to shift to income. But you don't have to sacrifice the what we call the organic growth in the portfolio and see the portfolio potentially build over time. Because guess what? You can take those interest and dividends, maybe from some good value-based dividend-paying stocks, and even when the market's going down some, you can just take those dividends and reinvest it. I mean, I'm 41 years old now, and I have a lot of my money in income. And you're probably looking at me like saying, well, why would you have so much in income? Because if you're reinvesting all the time, even when the market's down with those dividends, what it can do is provide a lot more income in the future for when I choose to retire one day.
So even though at your age it could be okay to have growth as a priority and income second, there's still lots of good reasons to have income as the priority, even at age 41.
Absolutely, and I'm not somebody that says everybody needs to be invested for income by any stretch of the imagination. If somebody is in their 20s and 30s and even 40s and they're not going to retire for many years, they can take the risk and growth. But before retirement, it's a good idea to make that transition. But Dave, thanks again for joining us today.
Of course.
I'm Wes Wood, the Income Guy. Thanks for watching, and if you have any questions about anything we've covered on today's show, please reach out to me at retiretv.com or by calling 855-776-0614. Be sure to tune in next week.